You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We had a lot of the train companies reporting some earnings, so that means we have to check in with Lee Klaskow. He covers all the transportation stuff for us, trains, trucks, ships, the whole thing, air freight, does it all for Bloomberg Intelligence. So, hey, Lee, thanks so much for joining us here. Again, export coal, that's the dirty stuff. We'll send that to Europe. The clean stuff out of the Powder River Basin in Wyoming, which I've been to, by the way, that stays here. What are you hearing from the railroads this quarter, Lee, so far?
Yeah, so it's been I wouldn't really call it a mixed bag. We've had pretty much most of the rails beat expectations that have reported. There's one left that hasn't reported, Canadian Pacific, but Norfolk Southern reported this morning, and they missed by 4 cents, and you can see the stock is down around $6.50 right now. And really driving that weakness is not so much the miss, but it's their outlook. You know, they're expecting their margins to improve 100 and 150 basis points annually over the next 3 years, but consensus is at a 250 basis point improvement. So consensus is pretty much in line where management is expecting revenue to come in, which is around 3% growth, but it's really on the cost side. And you know, this railroad has been dealing with a lot of additional costs. They were made headlines, unfortunately, earlier last year due to that devastating derailment in Ohio, which created a lot of chaos. The good news for them is that, you know, they are really focused on improving their operations. With improving operations also comes improved service and safety. That's all been doing quite well, but it also comes with higher costs. Norfolk Southern is trying to build a more resilient network. So next time, you know, something like this happens, and let's hopefully it never does, but you know, it's an outdoor sport, and things can happen when operating a railroad that are kind of beyond their control. But, you know, it allows them to kind of bounce back. And the management did mention on the call this morning that they got some kudos. You know, I guess they wanted to highlight some good news that they had from some of their customers, because a lot of rails faced some serious weather in January, and they were able to snap back a lot sooner than maybe some of its peers because of this resiliency that they're building into their network. And again, that comes with higher costs.
So, Lee, that's a Norfolk Southern story, which in some ways had idiosyncratic stuff going on. But you also had Union Pacific, you had CSX, and both of them had a cloudy outlook also for 2024. What's our macro read-through for that?
Yeah, so, you know, we've been in a freight recession for quite some time. You know, there has been no soft landing for the freight markets. You know, weakness kind of hit in 2022. The good news is that, you know, we could have some growth this year in 2024, but that growth is going to be probably pretty anemic. It can be anywhere between low and mid-single digits. So the outlook is mixed because it really depends on the commodity type. So the demand for automotives is still strong. You know, intermodal.
I was going to say, aren't we spending and buying lots of stuff?
We are buying lots of stuff, but a lot of that stuff is coming from warehouses versus coming from overseas. So you know, while inventory levels are getting normalized and the destocking cycle appears to be over, you know, it doesn't really seem that retailers or other businesses are looking to build inventories, just given the uncertainty that we're facing from an economic standpoint. I mean, you know, we all know that, you know, at least from consensus estimates, that economic activity is going to be moderating this year versus last year. And so, you know, again, with the mixed bag, you know, Paul mentioned export coal earlier. You know, export coal was a fantastic business for a lot of these carriers last year. That is expected to cool. Utility coal is really going to depend on the weather and where stockpiles are. So that there's a lot of uncertainty around that. And, you know, you mentioned, you know, the idiosyncratic story of Norfolk Southern. The thing about railroads is, you know, while there are some like macro overarching themes, you know, each railroad operates a different network with a different mix of businesses and different benefits. And so, you know, it really becomes a rail-on-rail story versus, an industry story. But, the one overarching theme that I would say is that volume is going to be better this year. Margins are probably going to be better this year. That should drive earnings growth.
Alex, one of my first gigs back in the day was I covered the railroad and trucking industries.
How many jobs have you had?
Oh, I've been around. And my
can't
first
hold the job, apparently.
I can't hold the job. That's very true. Lee, my first earnings models, you could still take a look at them, but they're on floppy disk. So I'm not sure how we necessarily get access to them. Lee, do you care? Do you have a preference, Eastern railroads versus Western?
That's a great question, and what I would say is that I do like Union Pacific, which is the only pure play Western rail. The Eastern rails are Norfolk Southern, CSX, and the reason why we like Union Pacific, and that's one of our focus ideas in Bloomberg Intelligence, is that we believe that their new CEO Jim Vena can do a lot with the company. He joined, I believe, back in August. He was their COO, left, and he's really known for being a great operator at Canadian National. Canadian National was one of the first railroads to employ precision scheduling railroading. He's also a disciple of the legendary and late Hunter Harrison, who is kind of considered the godfather of PSR railroading. So, we think he's going to come in and do a lot in terms of it really improving the operations. And not only do we like that aspect of it, but we also, believe that company has maybe gotten a little bloated over the years, and I think there's some, cost opportunities there on the corporate side. And, and it's not just about costs and operations. It's really about their network. They have a really fantastic network. They have exposure to cross-border freight between the U.S. and Mexico. While nearshoring is not going to happen overnight, it is a long-term secular trend that we really like. It might be like watching grass grow, or paint dry, whatever your analogy is. But in terms of that growing, but it is going to grow, and UP is really going to benefit from that. And then also, in addition to their intermodal business, Paul alluded to, they truck coal out of the Powder River Basin. It's lower sulfur coal, so it's quote unquote cleaner. We're not getting away from coal overnight, and that is a good foundation for them. Not to mention some of their other businesses that they're involved in.
Yeah, just don't tell the Biden administration that part. Right. But so to that point, though, to politics for a second, if we get a second Trump presidency, what happens to the import-export world? And does that affect the railroads in the same kind of way if we're looking at maybe a 10% tax on all imports, for example?
Yeah, that's another great question. The reality is it just becomes a tax on the consumer, right? Because if there's not an alternative for a particular product, we are going to import it no matter what. So yes, increased tariffs are inflationary, so it's not necessarily a good thing, but it certainly complicates things. And what I would say on the West Coast is the West Coast could benefit, at least in the near term, from what's going on in the Panama Canal. As I'm sure you know, there's low water levels there. I think you've heard of something going on in the Red Sea in terms of the Suez Canal. Container liners are not going through the Suez, so they have to either go along Africa, and some of that that freight that was destined for the East Coast might just go trans-Pacific directly to the West Coast and then intermodal across the country. So, there's some pretty interesting near-term opportunities. And there's also, we like to talk about labor a lot. In September, there is a contract that expires for the workers along the East Coast and Gulf ports. Shippers might want to divert freight to the West Coast to kind of avoid any labor disputes or labor issues that might arise, which would gum up supply chains on those ports.
Yep, we've seen that before. All right, Lee Klaskow, great stuff. As always, Lee Klaskow, Senior Transportation Logistics Analyst, Bloomberg Intelligence. He was over in Asia last week meeting with shippers and investors. So is it a global story that he follows there?
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alex, we're talking about the good economic data. It seems like a soft landing is certainly in the cards here. And I look at the WIRP function, the World Interest Rate Probability Function, WIRP, go on the terminal, and it's got like a 45% probability of a rate cut in March. I don't really care, I don't think. I don't care when it happens because I know it's going to happen. Mm-hmm. I don't really need the when. But I don't. People still talking about that. I don't know. It just feels like, boy, if rates are going to be cut, I'm in good shape.
Well, yeah, but it's not the when now. It's the how much and how long.
Yep.
And then
absolutely.
That really matters to like the belly and the.
But for some people that actually do this for a living, it kind of does matter. Dana Dioria, she's one of those, I believe, co-CIO at Envestnet in Berwyn, PA. I'm a big fan of Berwyn, PA, that whole part of the state. Dana, thanks so much for joining us here. I mean, do you care when the Fed starts cutting rates? How do you viewing the Fed? Because we're going to hear from the Fed next Wednesday.
I think given the fact that the market is pricing in to the point you just made, sort of this almost 50-50 at this point. I think we are getting to the point where exactly when that cut happens matters a little bit less than maybe it did. Obviously, we started the year and ended 2023 with much higher expectations of a March rate cut, which I never quite could square because we were also very sanguine about the possibility of a downturn, and that you saw more and more the priced in this notion of a soft landing. So the Fed, I mean, they on the one hand, you've got this massive debt we're carrying, and they're not oblivious to that. So cutting rates, is helpful there. But looking past that and just, their mandate, unemployment and inflation, unemployment does not suggest that they need to be cutting rates right now.
Right.
So I'm not one who thinks the Fed is oblivious to what's going on in markets, or that, they're just, but at this point they really have breathing room here. And so, Dana, I think it could go away, but I don't think they have to. Go ahead. Yes.
So Dana, I wonder maybe whether they cut in March matters to certain parts of the market. Clearly the front end, right? Maybe like 3-year notes. Does it matter to the stock market? I'm just trying to understand what's trading on what. So like what's going to be trading next Wednesday at, 2:15 p.m.
I do think it matters. I mean, there's just, fundamentally, right? There's the whole, if you have longer dated cash flows and, so growthier stocks, for example, should tend to react negatively to higher rates because you are discounting back these longer dated cash flows at a higher rate. And so if I'm doing just a basic intrinsic value calculation, it should matter a lot to me if I have longer dated cash flows, if I have a lot of that value of my company is in the terminal value, that these rates that are higher for longer should negatively impact. Of course, that's one input, right, in a million inputs. And then, additionally, if we look at value stocks, for example, low price stocks, they're shorter duration in nature, so maybe it shouldn't impact them as much. But they also compete with bonds for, they tend to be dividend yielders, and they compete with bonds, so higher rates impacts there. But I think this is one of many things going on. I think growth stocks. You talked about tech, or you've been talking about tech, communications, et cetera. And just where those companies stand in terms of like the defensive posture, the fact that they are looking at higher income and that they are revising up, whereas other companies are not. So it's one input in many.
All right, Dan, you mentioned fixed income here. How do you feel about the bond market here? It was just brutally crushed in 2022. Got some positive performance in 23 thanks to the last couple of months of the year. Kind of soft so far this year. How do you think about your allocation to fixed income?
Yeah, I think the starting point is so different, and we tend to be talking about it the same way as when we were starting at rates being rock bottom, and it's not the same, right? I mean, it's a very different starting point, no matter how you cut it. Even the route we kind of saw last year a little bit was short-lived, and to your point, you got the money back. If you're looking moment to moment at the correlation between stocks and bonds, then you're nervous about patient to a certain extent because you're not seeing this hedging effect that maybe you're looking for. But if you just open the aperture a little bit in terms of the length of time you have, I'm a strong believer in still having a robust bond allocation. particularly now, because again, I mean, there's only so far rates can go one way or the other at this point. It's not like it was, starting again from a rock bottom and, massive increases that you have to stomach. So I see that allocation as being necessary, as being good ballast for a portfolio, and there's not the danger there that there was.
Do you like tech?
I love the question. You can't not like tech. I'm a person who says tilt a little because you're getting so much tech, whether you're in an index or you're, even actively managed, they can't get that far away. It's too big. It's too much a part of the index. So I am a person who will say tilt a little bit towards, some companies, lower priced companies, just to offset some of that, concentration risk. But you can't get away from tech. You need it, and you can't be too far on the tracking error.
So, Dana, we're kind of just getting to the teeth here of earnings. I haven't seen the actual numbers per se, but it just feels kind of meh to me. Some companies are doing okay, some companies not. What are you looking for this earnings season?
I think you're right. That's the exact right word that I don't think that's a super big surprise, right? Because even if we stick the landing, there to some extent, we should expect corporate America to have some impact from the fact that you've had this massive increase in interest rates, that they have to contend with inflationary increases. A lot of these things can be lagged in terms of their effects. So, I mean, we can't expect to, hit the lights out every single time. And, even if the market is kind of absorbing this, and even if we're seeing that, wow, inflation actually is coming in. I mean, had another good print, in terms of just where we want to be. We're moving our way to the 2%. Mm-hmm. I mean, it's almost too good to be true to a certain extent. But at the end of the day, corporations, it's a varied landscape. They're all dealing with different parts of that inflationary increase, parts of what it means to go back to bond markets. So I'm not surprised. I think the 2024 forecasts matter a lot. What do we expect by the end of this year?
Yeah.
And that'll tell you something about whether we're trending toward recession after all.
All right. Dana, we're going to leave it there. Thank you so much. Appreciate it. Dana D'Auria, Co-CIO of Envestnet, joining us.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
It's time to take a look at some earnings, and some earnings for the regional banks, because around this time last year, there were some issues. And around that time last year, we met this guy named Herman Chan. And we haven't been able to get rid of him since. Herman Chan is the regional banks analyst on Wall Street. He works for us at Bloomberg Intelligence. And boy, do we depend upon him over the last years. We're trying to really get a handle on what's happening with the regional banks in this country and what types of pressure are they under. Herman, thanks so much for joining us once again here in studio. We're back into earnings season for some of these banks. Tell us what you're seeing and maybe what you're hearing from investors in these regional banks.
Yeah, thanks. Regional banks have largely completed fourth quarter earnings at this point. I'd say it's more of the same. Revenues are still off about 2% on average. Loan growth's not really there because there's lots of weaker demand, especially from commercial borrowers, and banks aren't really doing a lot of commercial real estate lending at this point, given a lot of potential risk ahead for that particular asset class. And so banks are focused on button down expenses and building capital. So there's not a lot of good news, at least in fourth quarter results, but banks are expecting a return of loan growth later in 2024, and that's really a function of lower interest rates increasing demand.
How are their deposits doing?
Deposits are pretty stable.
Because that feels like a big bright spot.
That has been an area of concern, particularly after the regional bank failures of SVB, First Republic, and Signature Bank. But at this point, banks have lifted interest costs and made deposit pricing more enticing for depositors across the board in money markets and CDs. So that's really the area of growth for the regional banks, but they're still seeing attrition in those, zero cost deposits, the deposits that are in checking accounts that aren't generating any sort of interest for for customers.
So one of the tickers I learned a year ago from Herman was KRE. That's the Spider S&P Regional Banking ETF, a great proxy for regional banking in the U.S. Year to date, that's flat.
Right.
Trailing 12 months down about 10, 11%. So the question I always have for you is, I work for a hedge fund.
Right.
I want to go into my hedge fund manager. I'm a hotshot young analyst covering in regional banks. I want to go in and say, give me another 50, another $100 million, because I think it's time to go long regional banks.
Right.
Are we there yet?
If you went long at the end of October, that was like that was the time, right?
Okay.
That was the time. That was like sort of the inflection point. The banks were at the trough valuation levels, and then the market sort of turned around and expected robust interest rate cuts, and so the valuations of the banks have started reflecting those rate cuts, and the market's a bit more optimistic for regional banks, largely because when rate cuts happen, you have lower funding costs and sort of potential growth in the balance sheet, as I mentioned earlier. So that could help
It's a
improve
35%
sentiment.
move off that October low.
That's
for this.
right. So
Okay.
that was the time to get in. At this point, a lot
Where
of
were you in October
the
for me?
easy money. You should have brought me in
Yes.
October. I would have talked about it.
No one wants to talk about it when they're doing well.
Yeah,
right?
exactly.
So Herman, another issue was those hold to maturity bonds, right? And the
Right.
disconnect between
Right.
deposit and the short versus long-term maturities. What are they doing to fix that? I mean, do they
Right.
need to? Are they offloading loans to, say, other big banks? What are they doing?
Yeah, so there's a few dynamics going on. One is that with the longer term rates coming down, those unrealized losses are actually improving. So you've seen book value growth because of the lower paper losses across the board for the industry in the fourth quarter. A few of the banks have recently started selling these loans at a loss and then reinvesting at higher prevailing rates. So you take the upfront hit, but then you improve your net interest margin and your earnings power going forward by reinvesting at current yield. So that's a strategy that's happening. Maybe that happens a little bit less with interest rates potentially coming down going forward.
So other than that spate of a handful of banks roughly a year ago, have we had any other notable bank, I don't know, not failures, but just angst? Yeah.
Yeah, the angst was really relegated to those three. There were a couple banks like PacWest that was in the headlines, and that found a buyer in Bank of California. Another bank that was definitely in the headlines was a bank, as you recall, Western Alliance, that they have done a tremendous job of shoring up their deposits and really getting back to the good graces of the market. So there's no real concerns there, and they actually reported yesterday after the close, and the stock's up 2%. So favorable results in the fourth quarter. So at this point at the stage, it seems like the rest of the regional banks seem in pretty good standing.
All right, let's talk about one of my favorite topics, Basel III Endgame.
Oh, yeah.
Right.
Mostly because it just reminds me of the Avengers, and I love that movie. But, okay, so this is basically higher capital requirements for certain banks. And if you're the big guys, you got to put in a certain amount. And if you're sort of the medium players, you got to put in a certain amount. What's
Right.
going to be the hit to the let's call it $100 billion to $250 billion regional banks?
Yeah, that's a very good question. You hear of the bank CEOs like Jamie Dimon be very vocal about it being the Basel III Endgame being very negative for the U.S. economy and hurtful in areas like mortgage lending, etc. So, but for the regionals, it's fairly digestible. The big hit for the regionals is that their capital ratios will suffer from these unrealized paper losses that you asked about earlier. So that will be incorporated into their capital calculations, whereas that aspect is already in the big bank's capital. So some of the tailoring issues that happened during the Trump administration will go away and be detrimental for regional banks. But outside of that, the issues that the big banks complain about, it's more manageable for the regionals, and for the management teams for the regions have talked about risk-weighted assets growing, in the low single digits to the mid-single digits. So that's much more digestible relative to a 40% growth in RWAs that JP Morgan has talked about.
So you mentioned during a year ago when people were really concerned about this group, it's really going to be an earnings issue as opposed to kind of a balance sheet issue. Where are we in kind of getting through that earnings pressure, if you will, and maybe getting back to more normalized earnings power for these companies?
Yeah, that's right. There's still pressure on the margin because even though short-term rates, the Fed stopped raising rates at this point, there is still a trickle-down effect where, as I mentioned before, there is a mix shift happening from your demand deposits, your checking accounts, and moving into areas like CDs. So that deposit remixing is a negative for earnings and revenues, but that's petering out. Offsetting that is fixed rate repricing of loans and securities, so that's beneficial. So overall, revenues are going to stabilize and are starting to stabilize. That's happening. Potentially, that's going to be a second half event. So you're going to still see some headwinds, but manageable, with the second half potentially growing from better margins and balance sheet growth.
Herman, so great, so smart, best stuff out there. We're sorry we only have you on when there's a disaster for the banks. Herman Chan, Bloomberg Intelligence, Senior U.S. Regional Banks Analyst.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Eric Kazatsky joins us, Senior U.S. Municipal Strategist for Bloomberg Intelligence. Joins us here from the Bloomberg Intelligence HQ in Princeton, New Jersey. It used to be New York, which we fought so hard for, but now they've retreated to Princeton. Eric, thanks so much for joining us here. Yeah. What's going on in the municipal bond market here these days? What are the headlines?
You know what? We're just enjoying the starts of this new year and trying to noodle on the different headlines that we've been sort of thrown our way, right? So we had some speculation that there were some credit issues with Harvard. I think we've sort of safely put that to rest at this point, that they're going to be around for probably another several hundred years. And obviously we're getting a lot of questions on what's going on the southern border and how that would impact the states. Obviously we're not of the opinion that there's going to be a secession issue on the behalf of Texas, but it does bring up a larger conversation. What could happen when you have states sort of, going with battle to the federal government when there's so much at play as far as tax revenues going in each direction.
I love Eric because he can have energy and excitement about munis.
Sure.
Unrivaled in my 17-year career covering stuff in the markets. Eric, can we go to the fun topic of the election? Because it also kind of ties into the border issue. And I'm just wondering, how are we sort of prepping? How's the muni market thinking about a possible President Trump again?
You know what? I don't think it would be the worst thing for the muni market in the fact that we already sort of know what we're going to get, right? So Tax Cuts and Jobs Act came into play 2017. We're still dealing with that. A lot of the provisions are set to sunset in 2025. So if the fact that we do have another dose of President Trump coming in, we can expect a lot of those provisions to, become permanent and stay in place. Not great for the muni market in the sense that corporate tax rates will stay low, and that really does tamper demand from some of those buyers who used to really play in our market.
Hey, Eric, talking to you and reading your research, I learned about taxable municipal bonds. I didn't know that was a thing until...
Wait, really?
Yes. Mm-hmm. Talk to us about that market. How's that performing here?
Yeah, on a performance basis, slightly outperforming corporates. But I think the real thing to focus on when you're looking at taxable munis is the different credit aspect, right? So totally asymmetric credit risk bucket to corporates, and the fact that you're picking up another 20, 30 basis points of yield right now. So if we think the Fed's going to cut, now's the time to sort of jump into bonds because of a scarcity issue. I want to be grabbing more yield in a safer area to play, and taxable munis would check off a bunch of those boxes.
What do you think the tax code will be that may or may not impact munis, though? I thought the whole point, weren't they tax-free? Isn't that the whole point?
Well, sure, they are tax-free, right? But I think what we're expecting, regardless if it's a Republican or Democrat to come into the White House, is that individual tax rates are most likely going to go higher. With the amount of federal deficits that they're contending with, it really only makes sense that that's the path that we're going to head on. And at the end of the day, if taxes go higher, it's going to make municipal bonds a lot more desirable as sort of the last bastion of sort of, seeking a tax exemption for individuals.
You mentioned higher education here, and you have a note out, munis might have 99 problems, but Ivy League schools aren't one of them. Talk to us about that part of the market, that issuance category. Higher education, how often do they use the muni market, and are they good investments?
Yeah, so it really is sort of a bifurcated world when it comes to higher education, and it was one of the areas that we had a little bit of concern going into the year. But it's a story of have and have-nots, right? So you have the AAA credits of the world, the Harvards, the Yales, who have tens of billions of dollars in endowments, and then you have schools like Penn State, who are not 501c3. No, I'm a state school guy myself, except it was Pitt.
I wrote a lot of tuition checks at Penn State.
There you go. So, look, I mean, the credit profile of those two different schools is very, very different. We think their concern is really the less funded private education four-year institutions who really can't withstand, sort of a drop in enrollment year after year after year. That's where we're going to see some spread widening.
Spread widening. I like that you took us there, because what we've seen in the investment grade market, for example, is just compression in the spread. Like no matter what, there's been that compression. Why are we seeing munis widening? Like what's going on there? Walk us through that.
Yeah, I mean, I think it's a race to quality this year, and that's why we're seeing, much of the grabbiness going on is going to be in the AA and AAA names that are coming to market. Washington Geo was an issue that just did very well, both in the primary and secondary. But I think what's happening in our market, and sort of echo with corporates, is that you are seeing an overall tightening of spreads just due to supply and demand imbalance, and it's really been a theme for munis, I would say, dating back to 2017 at this point.
Eric, I'm thinking about my buddies on the new issuance market. How's the new issuance market look for 2024? How's the calendar look?
I mean, pretty full, and surprisingly so. I think a lot of the estimates for supply coming into this year across the board were it was going to be on the quieter side, but I've been surprised by the amount of preliminary new issue filings that have come out, and pretty sizable deals as well, right? We have some stuff in the high yield space, another bright line train issue coming, bridging the gap between California and Vegas, so that's going to be interesting to watch. Yeah, and the Massachusetts Children's Hospital deal, a subsector of healthcare that we always find interesting. So definitely something for everyone on the calendar.
What happens if the Fed cuts rates? More issuance? Like what's the knock-on effect?
Yeah. Well, I mean, look, our market can't do advance refunding. So it's not like if I have a mortgage and rates drop, I can refi anything, right? So on that aspect, we're not going to see a lot. But I do think to some degree that there's market timing going on in our space. And a lot of people didn't like the market last year. So if we have, 3-4 rate cuts, you could definitely see some more stuff pop on the calendar.
So what's the credit quality like out there in municipal bond land? I haven't heard of any big blowups recently.
And you probably won't, right? At least from the credit raters' perspective. They continue to sort of march higher as far as positive outlooks on the credits that we long have held to sort of be the bad boys of the municipal space, right? The Illinois and Chicagos of the world. So as long as sort of the opinion over the next several fiscal periods is that they're going to continue to pay their bonds, I think all is going to be well when it comes to credit quality in our space.
Here's a question that may tie into politics also. So clearly the Inflation Reduction Act is trying to be a catalyst for investment, and you're seeing a lot of red states get a lot of that investment, whether it's even with the CHIPS Act or it's building a new facility or battery storage, etc. And I'm just wondering, with Republicans talking a lot about wanting to repeal that, whether or not it actually happens, what would like a South Carolina do if all of a sudden they lost all this investment helped by the IRA and the CHIPS Act?
Yeah, I mean, well, speaking to the fact that they haven't done a lot of issuance, even with those matching funds available to this point, speaks to the fact of that market timing we just mentioned. But if they had to go at it alone, I think they'd find a very receptive municipal market who'd be happy to finance them at very competitive rates. So, the availability of money to finance the amount of things that actually need to get financed in our space, there's no shortage of that.
Wow.
So what are the sectors you like here? I mean, do investors in your world, do they look at sectors like I want to be in healthcare or I want to be in transportation? How does that typically work?
Yeah, I mean, look, a lot of the products in our area, they're trying to beat an index, right? And it's sort of broad-based. But yeah, there are definitely investment vehicles that are focused on sectors. Some of the sectors that we think are going to be more interesting this year are healthcare, right? Shaking off some of that pandemic pain they've been dealing with the past several periods, right? And hopefully what we think is going to happen is a little bit of spread tightening based on some, more normal margins coming back to the space.
All right, very good. Eric Kazatsky joins us, Senior U.S. Municipals Strategist for Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Brian Egger. He is our senior gaming analyst. He covers all those casinos, all the hotels, the cruise lines, all that kind of good stuff. He's been doing it for decades on Wall Street. We got a Super Bowl coming up. Super Bowl's in Vegas. That's got to be good for Vegas. Brian, how big?
Yeah, it's big. I mean, it's the first time Vegas is a host city. You know, I think if you look at other analogous types of big events, the Formula One Grand Prix back in November, what we saw for that event, November 23 versus 22, is you had table game revenue shot up, room rates shot up, slot revenue was a little weaker, but all the high-end business for both gaming and hotels certainly benefited. We'll see what it does to the bottom line in terms of how many rooms they gave away. We'll get a better sense of that during earnings season, but certainly from a top line perspective, these big events are really powerful, and the Super Bowl in Vegas, we expect the same.
So Brian, we keep getting really solid economic data. The consumer is definitely spending. Are they still spending on experiences and stuff? And is that helping gambling and casinos?
They are. They're definitely spending on experiences. Vegas is a big beneficiary of that, both on the gaming side and the hotel side, and the convention business being back as well. Vegas is certainly up. Vegas is up very significantly versus 2019, but it is up also year over year. The comps get tougher, but it's definitely benefited.
I mean, so Vegas, one of my favorite towns of all time.
Is it really?
Oh, yeah. 3 nights, it is my favorite place in the world. 4th night, I'm like, I'm done. So, I mean, the convention business, that's how most people get introduced to Vegas here, this convention business. So I know that's such a big part, and I know that's back. Is Vegas at the point where it always seems like they can't possibly think about building another big resort, yet they do?
Yes.
And they sell the rooms, and they get the rates. It's just amazing. Where are we in kind of the development of Vegas?
So the big recent opening was the Fontainebleau opened in December 13th. So that's a recent opening.
And where is that?
That's also the north part of the Las Vegas Strip.
Okay.
The old, so it's and also we had back in 2 years earlier, we had another major opening with Genting's Resorts World.
Right.
So we are seeing some development. In percentage growth terms, each of those openings is maybe a 2% increase in room supply.
Yep.
So it's nothing like back in the 90s when you had
several
openings in a quarter. But nevertheless, it is kind of filling out some of the spaces.
And that's when he was at DLJ killing it on the street, doing all kinds of
so it's the opening parties for the Luxor in 1993.
Okay, so speaking of the opening parties, Jody Laurie, who covers cruise lines and stuff, went on, what was it again?
Yeah.
Icon of the Seas.
Icon of the Seas, right? And talk about like here, something's opening, come join us. And she was saying the whole point of these cruise lines is they want to be Vegas on the seas. I mean, I'm extrapolating. But is the cruise line industry eating away at Vegas?
Yeah, so they all, first of all, I have to say, Jody went on a cruise and all he got is this lousy t-shirt.
Yes.
That's like,
we didn't
I
get
did
a
not
t-shirt.
go on that cruise, right? I didn't get a t-shirt actually. But I mean, to the point, yes, I mean, they're all competing for the same discretionary dollar. Cruise lines are doing well. Vegas is doing well. In essence, they compete for a similar customer. The penetration expansion is a lot lower for cruise lines, but they're all benefiting, and we've yet to see the consumer roll over. Comps do get tougher, but the appetite for experiences and leisure travel remains very strong.
Talk to us about the sports betting business. It's legalized in so many states now. Yeah. It's gotten so big, and it's listen to sports radio. It's every single ad. Yeah. It's on television on all the big sporting events. It's just exploding. Talk to us about that business as a business of itself, and then maybe is that impacting kind of the sports books at some of these casinos?
Yeah, I think first of all, in terms of the business, Vermont just started up mobile sports betting this month. You had North Carolina recently. We're filling in all the states. There's more and more of it. The big challenge has been gaining profitability. So what they are doing is targeting promotions more effectively. They're reaching now the point of actual profitability, a much better point than they were a year ago. Companies like DraftKings. I don't really think it competes directly against brick and mortar sportsbooks. Maybe it does to some degree, but in markets where you do have both mobile and brick and mortar, mobile gets to such a bigger part of the pie.
Can I just share my story about gambling?
Sure.
So I went to the Bahamas with my husband, and we were at an Ultimate Texas Hold'em table. A 21-year-old got quad queens.
Wow.
And it was amazing. I know that's not sports betting, but that's like the moment you live for. Like, that's so cool. And he cried and called his mom. It was so great. But for sports betting, how hard is it to understand, like, okay, it's legal here, it's not legal here? Like, does that get into difficulty when they're reporting their numbers?
In general, you're right that gaming is legalized and regulated on a state-by-state basis. It's true of casinos, it's true of sports books. Now we're seeing online sportsbooks, online sports betting legal in north of 25 states, right? So it's really a significant, something like 45% of the U.S. population has access to an online sports book. There are some states where it's not there yet, but since the Supreme Court blockade against this was lifted a few years back in 2018, we're really significantly expanded the industry. So it is maybe some confusion, but more and more it's becoming ubiquitous.
Yeah, I'm looking at the FA function for DraftKings. They're going to be, I guess, finally turn EBITDA positive this year for the first time. So these guys aren't even making any net income.
It took a while. And what happens is you introduce a sports book, takes a couple of years to reach maturation. You eventually build an audience and you can take the promotions and giveaways down. And that's what they've done. So in states that are really mature, like New Jersey, been around 5 years, they're much more profitable than a newer state. But overall, look in the UK and Europe, you've got online gaming is more profitable, but it's a much more mature business.
Yep.
Interesting. So interesting.
I know. So, I mean, how about that? You also do some work on the regional casino companies that aren't in Vegas. How's that business doing?
They're doing well. I mean, it's still up
think riverboat casinos.
Yeah,
right?
but not really. But usually not on riverboats anymore. But they're still.
Paul, we're Jersey guys.
They're still
you have
water
to ask
adjacent,
about Atlantic
right?
City.
It's
near the water.
Boring. So depressing.
No, I didn't find AC that depressing last time I
Really?
went.
Okay.
Yeah, I went to see Amy
Well,
Poehler and Tina Fey. It was really fun.
I saw Sinatra down there 8 times during high school and college. Go ahead.
Okay, that's okay.
Really?
Yes. It's easy. We drive down.
That's a whole other conversation.
Yeah, it's a whole other
Yeah,
conversation.
we're from the same era, so I'm sure I did too back then. So, I think the original game business is doing well. It's still up well over the pre-pandemic. It's up year over year. I think the comps do get tougher. Just because we've seen so much growth, particularly. So, comps are a little tougher, but it's still doing well. I think the margin story gets tougher.
10 seconds on
labor,
AC. How's AC doing? 10 seconds.
AC is doing okay. I mean, it's like other regional markets. It's up year over year. The big challenge for all these regionals, I'll throw AC in there as well, is costs, competition.
Yep. All right.
Labor
You're okay,
costs.
John? I got a little AC talk in there for you.
It's not Vegas. I don't. The people there just aren't as friendly as the people in Vegas.
No, they're just the pit bosses, the dealers, they yell at you and stuff. But I have a good time when I go down there, so it's all good. Brian Egger covers all the gaming stuff.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.